Please stay tuned after the conclusion of the podcast for additional important information. Welcome to Accrued Interest, a new podcast from PIMCO focused on serving financial advisors and their clients. Accrued Interest is part of PIMCO Advisor Forum, our newly launched dedicated platform for financial advisors. You can visit us there at PIMCO.com. I'm your host, Greg Hall. I head the U.S. Wealth Management business here at PIMCO. It's a real pleasure for me to be introducing our second episode, increasing our episode count by 100% for those of you keeping track. It's an even bigger pleasure to be joined today by my friends and colleagues, Libby Cantrill and Andy Maloney. Andy, you drew the short straw today. You'll be my co-host for the program.
Can't wait.
Andy's a senior vice president here at PIMCO. He's a highly tenured account manager. He works with FAs across New York and Connecticut. Hails from Fairfield, Connecticut, which has been a strong talent pool for PIMCO over the years.
Sure has.
The star of today's program, though, is Libby Cantrill. Libby's a managing director. She's our head of U.S. public policy. Joined PIMCO in 2007 after starting her career at Morgan Stanley, spending time on Capitol Hill as a legislative aide. If you recognize Libby's voice, it may be from her very frequent appearances on CNBC, Bloomberg News, and other outlets. She has crisscrossed the planet on our behalf, tirelessly visiting with clients to help them think through the impact of politics and policy on markets. Welcome, Libby.
Thank you. So excited to be here.
I joke about how you crisscross the planet, but I really mean it, and I do want to start today's program with a thank you, especially this year. You've just been an extraordinary partner to us and the clients we serve, and moving around and helping to explain the latest developments in the election and what the implications are for policy and politics and markets.
Greg, I appreciate that. It's actually one of my role's sort of greatest joys, really, is to talk to our clients, and particularly when there's a lot going on, and we can help provide at least some frameworks for how to think of things. So it has been. It's been tiring, but but it's also been fun.
I'd imagine it helps you keep like your finger on the pulse too a little bit, right? Like
for sure, and of course, I mean it's quite interesting because you go to different geographies in the country and you hear for sure different feedback. But also, I mean, just globally, I'm having the opportunity to have really visited most continents over the last few months, just in terms of how our clients are thinking through the election and ramifications. It's an education in and of itself. So.
Did we happen to book a lot of swing state travel for you this year? Is this part of your fact finding?
Actually, yes, and I make it a point whenever I'm in a swing state that I ask, my Uber driver, the person who's I'm ordering coffee from, just try to drop just politely, about politics and trying to get sort of a feel for how they're thinking through things, and sometimes on that on the ground research can be quite helpful.
Libby, I think your role's so cool. Not only do you advise our investment committee on policy and politics and how they might affect markets, you serve PIMCO's interests in the industry, you represent the industry, you represent PIMCO, on Capitol Hill. You travel around, you get to meet and sample opinions from so many different types of people. Maybe you could do us a favor and give us a better sense of your day-to-day. What's your role here really like?
Yeah, I mean, it is a great job, I have to say. I feel like I have one of the best jobs, honestly, not only at PIMCO, but sort of writ large. It really is, in some ways, a dream job. So, my kind of task is to look at the intersection of politics, policy, the markets, and the economy, all to help our portfolio managers make better decisions in terms of trying to drive alpha for our clients, but also to help our clients, as we talked about. And honestly, any given day will look very different. During an election cycle, it is oftentimes talking to clients or talking to either our investment committee or specific sector desks, trying to just evaluate kind of what the general range of outcomes are, depending on election scenarios. The other years, however, it's very policy intensive.
Yeah, where your expertise, I think, is really truly differentiated, not just at PIMCO but in the industry at large. Andy, I don't want to leave you out. What's a day in the life of Andy Maloney like?
Well, I serve financial advisors in Connecticut and New York, and first thing I do, like most of our clients, is review our morning notes, check performance on a lot of our funds and other portfolios, and then I usually see which of our advisors decided to allocate some capital to PIMCO that day that had been trusted by their clients, and then express gratitude for that. This election cycle has generated a lot of activity, leading to in-depth conversations about the results, the ramifications, and portfolio construction.
Yeah, I would imagine a lot of incoming questions over the last couple weeks in particular. I mean, just to contextualize it right, I mean, we all came back, sort of from summer vacation, August, back to school. As soon as back to school's done, Fed cut, right? 50 basis points off the mark. Then some interesting data readings kind of early on, and then right into the election. So why don't we talk about the election? We got Libby here. Let's move on to.
I didn't really have a summer vacation. I would just like to tell you that. I was like, well, that sounds charming, a summer vacation. Well, if you just remember what happened in the election cycle, it was not really a
We
quiet
were glad
summer.
you were working so hard on our behalf.
Seems like a lifetime ago.
Yeah, exactly. Wow, yeah.
So the election, is it
Yes.
over?
Oh, it is almost over. And I think, regardless of one's politics, everyone can be very thankful that we did have a decisive result at the presidential level. That, of course, President Trump not only won the Electoral College by winning the battleground states decisively, but he also won the popular vote. And he did that really by, eating in to some of the traditional Democratic coalition in some of the blue states, like here in New York. But it was decisive. Now, some of the votes are still being counted for the down ballot races. But for all intents and purposes, we have a good sense for now how things are going to look in 2025. Of course, not only at the presidential level, but also in both chambers of Congress, the House of Representatives, and also the Senate.
And with a caveat that anything can happen. You seem pretty confident we know how things are going to look. Do you want to walk through what that's
Yeah,
going to
so
look like?
I think one big surprise, again, not only was, not that Trump won, because I don't think that was a surprise or shouldn't have been a surprise, but just the fact that he did so well in some of these traditional blue states. But one thing that was another surprise, another kind of component of the election, was that there was a lot of split ticketing, much more split ticketing than we've actually seen in previous election cycles.
Split ticketing.
So it means that if a voter will vote for one party at the top of the ticket, so for the presidency, but then vote down ballot, meaning for the House or the Senate race at a different party. So what we saw was that in many of the states, these battleground states where President Trump won, and decisively in Michigan or Wisconsin or Nevada or Arizona, the Democratic Senate candidate also won. And this is sort of the punchline for markets. He doesn't necessarily have the majorities in Congress that you would have expected given how decisively he won. And what do I mean by that? In the House in particular, Republicans will either have a 2 or 3 seat majority, meaning that to pass any sort of partisan legislation, you need 218 votes in the House. He can only lose 2 or 3 votes and still pass a bill. Now, just to put that in historical context, in 2017, Trump had a 23% majority in the House of Representatives, meaning that he could still pass legislation, and even if he lost 23 Republican votes. So this is just a very, very narrow House majority. I can't underscore this. That is not really a governing majority. It's going to make things that are difficult even more difficult. We'll talk about tax cuts. Those are always easy to pass. It's always easy to give people dessert. But in terms of actually giving people their vegetables, that is harder, and that will kind of take more probably political capital and may be much more difficult to do.
So
just given those
the
narrow
rumors of the
majorities.
Republican sweep. I mean, not to take away from the victory itself or where the numbers came down, but the way that translates into governing power is a little bit more bounded than people might think.
Exactly, especially in the House. And then in the Senate, he has a 53-47 majority, again, picking up 4 seats, and we don't want to diminish their victories, but just practically speaking, for most things in the U.S. Senate, you still need 60 votes to pass things. So this is where, I think that there is absolutely some justified optimism in the risk markets in particular, but I think people should just remember that maybe some sort of restraint or sort of sobriety is called for, because some of this will just be kind of the guardrails in terms of what can actually get done.
Yeah, these are deliberative bodies, and they're still going to deliberate.
They are still going to deliberate, and in fact, they draw their power on deliberating.
Yeah.
So yes.
All right. So the one thing that I think is kind of interesting right now is we obviously haven't had a chance to see any new governance or new legislation from the Trump administration because they're not in yet. but they're beginning to identify the people that they want to compose that administration. And one of the things that you say, which I find both true and clever, is that personnel is policy.
I think what President Trump is signaling is the mandate that we were just talking about in terms of his personnel choices, is that he is picking the people that he wants, not necessarily the conventional wisdom or the Republican establishment want. Now, I think some of them, he may find it difficult to get confirmed, but more or less I would be surprised if not most of these folks do get confirmed. And so he really is going to be able to have the government that he wants fashion in his own terms. And he says this by his own admission. He learned a lot by being president, also by sitting out for the last 4 years. And so, like we saw with this campaign, this transition is a very well organized or very strategic and very intentional, for the most part, transition effort. And so the people we're seeing him nominate, and again, subject to Senate confirmation, are folks who, he really wants to serve in his government. Now, again, that advice and consent role that the U.S. Senate plays, they take that incredibly seriously. Again, their power is derived from that oversight function. And so I would be surprised if we were to see at least one or two of the noms not get confirmed.
Do you think if they exercise that right and a couple of the nominees don't get confirmed, can we extrapolate from that we've got a bit more of a constraint on executive authority in this next administration, or is that not something that we should extrapolate, say, to economic legislation or fiscal policy?
Yeah, I think, again, the starting point for most of the U.S. Senate, Republican and Democratic alike, is that the president, whomever the president is, should have their own people in government. And so I think that is sort of where they're going to start from. But then they take this process very, very carefully. And I think you're seeing a lot of folks be very intentional about not prejudging the outcome, that they're going to wait for the confirmation hearings, they're going to wait for the background information from the FBI and what have you. So I'm not sure you should extrapolate too much from it, because I do think that most senators come from that place of wanting to give the president, especially of their own party, the people that they want.
I want to ask one more question just about the formation of the administration right now, and then I think we ought to move on to some market stuff and policy impact on that. But we spent a lot of time at PIMCO obviously talking about fiscal deficits, and the path of government spending. Should we be reassured that the Department of Governmental Efficiency is going to take care of fiscal deficits from here on out?
I think what should we expect from DOGE is that because they're not part of the government, because they don't have any sort of congressional authority or any real ability to affect spending or tax policy, because of course that happens through the Congress, what we could expect from them is basically some recommendations to the president and to the U.S. Congress to potentially incorporate for future legislation. But this idea that the president will be able to cut $2 trillion from the U.S. budget deficit unilaterally. I mean, we wish he could, but he just can't. And this is where
that amounts to what percentage of the overall, right? Because it's an enormous percentage.
So $6 trillion is the annual U.S. government's budget. So $2 trillion, of course, of that is a third. I mean, even if over 10 years, though, you're still talking about $200 billion. Those are massive cuts. And just practically speaking, we're really talking about what is on the table is just about a third of the government budget, because 2/3 goes to either interest expense or it goes to mandatory spending, which the bulk of that is Medicare and Social Security. And of course, the incoming president has already said he's not going to touch those. So you're really talking about, again, a third, and then about half of that is defense spending. So then you're talking about non-defense spending. And even though there is absolutely waste and fraud in the government, like any big bureaucracy, when you actually start really drilling down to these programs, they're often pretty politically popular. So, the national parks, or making sure that our food is inspected, or making sure that planes are landing safely. I mean, when you actually sort of, peel back the onion, it's actually things that people really do care about. They may just not know that they care about. So I think, again, I'm not trying to prejudge, and we wish them luck, because I think we all are concerned about 6.5% deficits that the U.S. is running as a sort of a starting point before we even talk about tax cuts and what have you. But I think for all intents and purposes, this oftentimes is easier said than done. For better or for worse, this is the checks and balances that our founding fathers took so much pride in. It also means that things are really difficult to actually get done in Washington and kind of maddening to get done. But it also, means that they have to be kind of intentional in order to really affect major change.
So why don't we switch gears a little bit, talk about some of the policies that you think have a better chance of being actualized. What are some of the areas we ought to be looking at as very likely to occur?
So I think there are areas where the market really likes, and that's sort of where the equity market has been really focused on. And then there are things that may cause markets a little bit more indigestion, and that's where the bond market is focused more. It kind of depends on your lens. The things that I think rightfully so have been adding to sort of this risk-on sentiment have been around taxation, sort of the uncertainty that we may have had around tax policy. If Harris had been elected, for instance, we do not have under Trump, right? We know that he is going to try to extend all of the expiring individual Trump tax cuts at the end of 2025. We also know that, to your point, he made some promises on the campaign trail about no taxation on tips, reduction of the corporate tax rate for U.S. manufacturers. I think those things may be more difficult to get done, but maybe you have a sort of symbolic nod in terms of trying to honor some of those promises that were made. But for all intents and purposes, for people listening, the Trump tax cuts will get extended. I think one big question, though, is for how long? And one of the ways I think they're going to sort of try to maneuver from a deficit perspective is just not extend them for 10 years, but maybe just extend them for 4 years or maybe even a shorter period of time. And that just allows them then to sort of set up and get another fiscal cliff for the next president, most likely, but also to sort of reduce the deficit impact. SALT, I think, is going to be part of the mix for those of us who are
here in New York.
But I do think that the SALT cap will likely increase. Right now, as many people know, it's for 10,000. That could, maybe that increases to 40 or 50,000. I doubt, though, it's reinstated. It's super expensive to do so, and I just don't think they'll have the wiggle room to do that. So anyway, tax. So again, I think that's partly why the market has been responding. And then, of course, the other narrative that's justified is this sort of deregulatory narrative. I would put a little bit of nuance, though, around this, is that deregulation, very difficult to actually do. What I think people are responding to, and again, for good reason, is the sort of regulatory certainty, and that there's just more clarity around regulation, meaning sort of the absence of new regulation is what folks are responding to, and then the lack of enforcement, or at least not as sort of aggressive of enforcement as we've seen under Biden.
I think the term we hear a lot from advisors who are quite bullish on the quote unquote Trump trade is business friendly, animal spirits, right. Right.
No, and I think for our organization as well, that's true, right? Yeah. It will be a more straightforward administration to sort of navigate than maybe a Harris administration would have been.
Right.
So those are the things that are, I think, again, kind of risk on, and that's why the equity market has responded the way it has. I think the things that the bond market is responding to, again, deficits are going to be higher. We're starting at 6.5%.
You said throughout the campaign that no matter what happens, the deficit is the big loser.
Yeah, and I think that the bond market has internalized that to a certain extent. Of course, we saw that big steepening of the U.S. yield curve. We've seen sort of a subsequent flattening a little bit of it, but we do think that the yield curve, as we all have talked about, the yield curve should be steeper because of these ongoing deficits. Again, you're starting at 6.5% deficit as a percentage of GDP, this year. So you're already starting from a very high level, and that will likely just go higher, even with Doge. Even with some spending cuts, you're still going to be adding probably from a net deficit perspective. So I think that the bond market's reacting to that. But of course,
can we pause a little bit on curve shape? A lot of times when I hear even pretty thoughtful advisors, when they're talking about the fixed income markets, really tend to focus on just the absolute level of rates. Where's the 10-year going to be? That's the question that we probably get most frequently. And I think people don't appreciate as much as they could that the shape of the curve can be a huge driver of performance within fixed income portfolios. And kind of what Libby's giving reference to is this notion is that when you're lending to the U.S. government or to any entity, you get to decide how long you want to lend to them for. And if you feel like the deficit is kind of on the wrong track, well, you don't have to lend to the U.S. government for 20, 30 years, and you can actually bring your duration, the tenor, the longevity of your lending in to express that preference. Or you mentioned steepeners, you can actually make investments based on the shape of the yield curve between different maturities. And one, I think, even if rates trend higher, which isn't necessarily, a base case, but potentially maybe more probable than it was before we had the election results, the shape of the curve can move such that there's still a lot of terrific investment opportunities if you're actively managing around it.
Yeah, and I think that's that you're an active manager, right? This is where I do think this is a really ripe environment for folks like a PIMCO, right? So we could have a neutral duration position, but still taking a very active view on the shape of the U.S. yield curve, which is basically what our positioning is now, right? Which is kind of across our portfolios, this idea that, to your point, that if you're holding a 30-year bond, that you should likely be making more than if you're owning a 10-year bond, just because of that. I mean, you sort of require more yield because of those high deficits.
Time value of money, you're taking more risk.
All of those things. And because no candidate, no politician seems to be really serious about deficit reduction and what have you. So, I think that this is where, we think that the curve should have steepened. We would have said regardless of who won, Harris or Trump, but we did see this pretty violent steepening. Yeah. Now, of course, it's come back a little bit, but that is something that we think will likely exist. And again, you don't necessarily need to have an overweight to your overall duration. You just have different parts of the curve in terms of where you're exposed to.
Well, this is the topic of conversation in every client meeting today. Advisors are concerned about deficits, post-election especially. I polled all of my counterparts nationwide just to make sure it wasn't just me in Connecticut and New York clients. Are you worried about inflation? Are you worried about interest rates? Are you excited? Are you concerned post-election? First of all, everybody's relieved, like all of us at the desk, right? So that's number one. No hanging chads, no contested elections. We know where we are. But there's also a lot of excitement about this pro-growth, right? Deregulated environment. Yeah. But the flip side is there's also concern on our side, right, which is the bond side, where we spend a lot of time at PIMCO. So this concept that, hey, maybe this pro-growth, deregulated environment, potentially tariffs, which we'd love to talk about, leads to higher, stickier inflation. And what does that mean to a bond manager? And I think something that Greg and I talk a lot about every day, which is this concept of active, right? You named it. It doesn't mean you have to necessarily just own duration today. There's plenty of things to do for an active manager, and it's showing up in the numbers. It's showing up in the flows. It's showing up in the performance numbers. We're excited.
One of the things Andy said, Libby, that I think would be great for you to kind of address. And by the way, we don't know your answer here, and it doesn't have to be positive for the bond markets necessarily, but in our sense is that advisors post-election, their confidence in the path of interest rates, the path of inflation has been shaken. There's an unsettled sense of, hey, where could this go? So I'm curious where you think the boundaries are and what those factors, what factors could give rise to controlling those things.
Yeah, and again, I think this is where the bond market has expressed some of these concerns as well, not only in terms of around deficits, but other factors that could potentially provide upward pressure on inflation. One of those is tariffs, and the other is around immigration. Now, I think on those policies, we should absolutely take the president seriously. I mean, he's sort of told us what he's going to do, and I do think that it is kind of this misnomer in the market that, he won't do this because he cares about markets. This is true. He does care about markets. He does care about the S&P. He wants a strong economy. He believes that's going to be his legacy for sure. But I don't think we should underestimate that he cares about tariffs as well. He thinks tariffs are a really effective tool to reduce the goods trade deficit. And, most politicians don't know what the trade deficit is, but President Trump does know it. And his trade advisors are really focused on this reduction of basically how many things the U.S. is buying versus how many things countries are buying from the U.S. And they want that deficit because, of course, the U.S. we like cheap things from overseas, comparative advantage, what have you. Whereas a services economy, we're not necessarily a manufacturing economy. They would like that to decline. So I do think tariffs are going up. I think that the direction of travel of tariffs is clear, that they will be increased. But will they go up to the 60% that I think that the kind of the bond market folks really are worried about? No. I think it is very unlikely. I think what you're going to see is that this administration will be very sequenced about kind of how they put or how they kind of proceed with tariffs. But I do think it is bounded to your question. And what we saw is that, did tariffs, increase inflation the first time around? Yes, but it was relatively marginal. Mm-hmm. And like the producers and the countries, that are the companies that are, in these countries that are being tariffed, oftentimes at least eat some of the tariff. That's at least what we saw the first time. That's what our expectation.
Still a competitive market on the consumer side, trying to get goods into the U.S.
And I think the thing that would be the most inflationary would be this universal, baseline tariff of like putting a 10% tariff on all countries, and then China would have an even higher tariff.
What's the probability of that?
Look, I think that legally he has a lot of authority to do a lot on tariffs unilaterally. That is the one area where it's very murky. I think he will threaten that. I think he will be much more intentional and deliberate about where he applies those tariffs. So I would say, definitely lower than 50% odds, but probably even lower than that. I don't want that to conflate with the broader point that tariffs will be going up, but probably in a way that is a little bit more digestible for markets. The other thing is on immigration, and I think that the folks' views on the inflationary impact of reduction in the flow of immigration is probably a little bit overstated. I think that there's also some limitation about what the president can do unilaterally on immigration. That's much more of a growth issue than it is an inflation issue. So I think kind of a long way of answering your question is, yes, could there be these forces that theoretically could be inflationary, could add to inflation? Sure. But are they going to be kind of bounded by whether it's just what he can do versus, unilaterally, or this sort of nod to the equity markets and sort of risk sentiment.
Yeah, and I think a major difference also between today and a few years back is just the absolute level of rates where we're starting, right? The ability to absorb some increase in overall rates and still generate income, generate total returns is much healthier than it was when rates were at zero.
Absolutely. And again, we just think to be an active manager right now, when you see these market overreactions, it's like just a wonderful time to be able to, the fact that we have been kind of keeping our powder dry in some areas and we're able to extend capital and to take advantage of those dislocations is great. So in many ways, we like this sort of high rate, high volatile market because it gives us more opportunities to make alpha for our clients.
Let me just ask you one quick question before we wrap up here. I'm curious, as you look out over the next few months, what are the key things that we ought to train our minds on, make sure that we're looking for in headlines?
Yeah, again, I think some of these confirmation battles will be battles. They're not going to necessarily be, all that seamless. But I think that for kind of the market's perspective, does that really matter? I'm not sure. I think what really matters is who's going to be Treasury Secretary. The independence of the Fed. Our view is that concerns about that are really overstated. We think there are a lot of guardrails protecting the Fed. And unlike 2017, when President Trump was able to come in and basically nominate people straight away to the Fed, there are no vacancies on the Fed right now. This is a really important point. And as a result, he's not going to actually be able to put any personnel on the Fed until 2026 at the earliest, because that's when the first vacancy comes up. And he can't fire Jay Powell. He can't put himself on the Fed. All these things. And not to say that he wants to, but there's just a lot more kind of guardrails and checks and balances than maybe people appreciate. But in terms of kind of what to look out for, so again, more personnel decisions, who he has on his economic team, who he has the U.S. trade representative. That may sound totally banal, but it's actually quite important because that person will be in charge of implementing tariffs. So again, personnel is policy. So how he fills those slots will be important. But then I think also how quickly are they able to get things done in Congress, because they've put out a very ambitious 100-day agenda. I think practically speaking, that's going to be very difficult for them. We wish them well, but I think pretty difficult to actually really get all of that done. The other thing I think that we haven't really talked about that just, for folks should just keep their eye on is that there will be a debt ceiling fight. And that is going to likely come in later spring, maybe even the summer, sort of depends on revenues and what have you. So those are the things, like how much can they get done in that first 100 days? Will they really be able to get a tax bill done? Again, like unlikely, but we wish them well. And then sort of how that all feeds into sort of what could be maybe a little bit a surprisingly volatile kind of debt ceiling fight, just given, a question is what if they try to attach provisions that are anathema to Democrats.
Yeah. All right.
So never boring.
Never a dull moment.
Never a dull moment.
Never a dull moment. We covered a lot of ground. Andy, do you think we help some financial advisors just maybe develop a bit of a framework here to how to think about politics and markets over the next few months?
I think we did. I think they're yearning for information. They need help and guidance, and thank you, Libby. That was great.
Yeah, not shy about asking questions either. So we'll make sure that we route a few more questions to you over the course of the coming months.
No, fantastic. And of course, I have my Washington Watch.
Yes,
so folks
yes.
are able,
That's
if people would like to sign up for a Washington Watch, they are very welcome to do so. You can get our real-time thoughts on what's happening in Washington, the intersection of markets and the economy and politics.
Yeah,
we said
get
that
your
about
account
weekly.
manager to sign you up for that.
All right, Libby, Andy, thanks for joining us. Thanks for being here.
Thanks so much, guys. Number 2, I've always wanted to be second place.
Well,
Mark Steiner he was a good number 1, I have to say. But a real honor to be here.
Well, it's good to be in the top 3.
Exactly.
It's good to be in the top 3.
Exactly.
You're the
Beggars
down
can't be
ballot
choosers.
winner.
It's totally fine, No, but it's great. Thank you, guys.
All right, Libby, thanks. Let me, in summary, just hit a few key highlights from today's conversation just to make sure that we all walk away with some takeaways. First of all, seems to me like there's a pretty clear bet that we can expect some continued volatility in financial markets as the new administration takes shape. Now, as Libby said, there are some natural constraints on how quickly and how much the new administration can accomplish. I should also point out that volatility isn't always a bad thing. And I think we know this as financial professionals, that market gyrations give us the opportunity to make investments at times of fear or greed, allow us to position ourselves actively to take advantage of the opportunities the market gives us. The key determinant of fixed income returns historically has tended to be the starting place of yields, which are attractive in the market today, which is a stark difference from where we were 3-4 years ago when we were having maybe similar conversations about inflation and the direction of rates. Now, if you'd like to hear more from Libby, we'd recommend that you visit the Advisor Forum platform at PIMCO.com, where her work is heavily featured. You can also sign up for her Washington Watch email newsletter, which she sends out on a weekly basis, by contacting your PIMCO account manager. I hope today's conversation has given you lots of food for thought, conversations with your clients about tax planning, about their financial goals, their plans, risk management, portfolio construction. All of these are areas of expertise for our next podcast guest, John Nersessian, who heads advisor education here at PIMCO. He'll be joining us in December. Please join us again for a listen then. We look forward to bringing it to you. Until then, have a wonderful Thanksgiving, enjoy the holiday season, and we'll talk to you in December.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures